Hey guys, welcome back to Module 14. Here we're looking at managerial accounting, really the tools for decision making. So this module represents an important transition in our course. Up to this point, we've concentrated primarily on financial accounting. We've examined financial statements, analyzed profitability and cash flow. We've evaluated assets and liabilities, and we've even developed forecasts. Now we're shifting to managerial accounting. And the easiest way to understand the difference is to think about who's using the information and why. So financial accounting is primarily designed to communicate information to people outside the organization. Managerial accounting provides information to people inside the organization to help them make decisions and achieve organizational goals. So our managerial lens for this chapter is how can accounting information help managers make better decisions and execute strategy? So when we talk about financial accounting versus managerial accounting, we want to start with a distinction between them. So financial accounting produces general purpose financial reports for external users, and those reports follow established standards such as GAAP, generally accepted accounting principles, and they tend to focus substantially on what has already happened. Managerial accounting is different. Its audience is internal. The reports are generated based on what management needs, and they don't have to follow a prescribed prescribed external reporting format. And importantly, managerial accounting is frequently focused on current and future decisions. So think about the difference this way. A financial accountant might ask, what was our profit last year? But a manager might ask, what will happen to profit if we reduce the price by 5%? Or should we discontinue this product? Or should we make this component ourselves or purchase it from a supplier? Or how much do we need to sell next year in order to achieve our profit target? Those are managerial accounting questions. So looking at it from that perspective, a manager's perspective, when you ask a different question, you get different information. So if you're managing a company with 3 product lines, the company's annual income statement tells you that the business earned $10 million. That's useful. But now you have to decide whether to discontinue one of the product lines. Is the company's total net income enough information to make that decision? Of course not. You need different information for a different decision. You may need to know what costs will actually disappear, what revenue will be lost. Will eliminating the product affect sales of our products? Can the resource be used somewhere else? That's why managerial accounting is described as special purpose. We design the information around the decisions we're trying to make. So that idea will be really useful in chapters 15, 16, and 17. So look at the mission, the goals, strategy, and how managerial accounting really connects to all 3. So a company's mission communicates its fundamental purpose. The chapter describes goals as definable and measurable targets, and strategy is the course of action the organization selects in order to help achieve those goals. Why are we discussing strategy in an accounting course? It's because managerial accounting should support the strategy. Suppose a company's strategy is to become the lowest cost provider in the industry. Management needs accounting information that helps identify where costs are occurring, why costs are occurring, which activities add value, and which efficiencies can be created. Now suppose that the company's strategy is product differentiation. Management may deliberately spend more on product design, customer service, quality, or innovation because those activities support the strategy. So the managerial accountant shouldn't simply tell management to spend less. The better question is, are we spending our resources in ways that support our strategy? For strategic positioning, there's 3 broad strategic positions. You can have a cost leadership, product or service differentiation, or market niche. A cost leadership strategy emphasizes operating at lower cost. Differentiation emphasizes creating something customers perceive as unique and therefore may be willing to pay more for it. A niche strategy concentrates on a specific or specialized market. Here's the important managerial accounting connection. Different strategies can require different cost structures and different performance measures. A premium service company shouldn't necessarily evaluate every cost the same way as a low-cost competitor. If superior customer service is the basis of the company's differentiation, cutting customer service support costs could actually damage the strategy. So the cost management is not simply how do we minimize every cost, it's which costs create value and which costs don't. Planning, organizing, and control is something that's also supported with managerial accounting. Managers develop plans, and those plans require actions. Responsibility is assigned throughout the organization. Then the managers compare what actually happened with what they expected to happen. One of the examples in the PowerPoint compares budgeted costs with actual costs. The difference is then highlighted as favorable or unfavorable. This is one of the fundamental ideas behind managerial accounting. You plan, you act, you measure, you evaluate, and you adjust. Accounting information becomes a feedback system, and it helps management determine whether the organization is actually accomplishing what it intended to accomplish. So we would ask, under budget isn't automatically good. When you look at it from a manager's lens, suppose your department had a budget of about $1 million and you spent about $900,000. Did you perform well? Maybe, but I got to have more information. But perhaps you found a way to deliver the same results for $100,000 less. That's excellent. But perhaps you spent less because you failed to hire needed employees, customer service deteriorated, and sales declined. Now being under budget doesn't look nearly as impressive, and that illustration is something we'll see repeatedly in managerial accounting, that a favorable number isn't necessarily a favorable business outcome. Performance measures need context. When we look at the value chain, this chapter will define that as the set of value-producing activities extended from basic raw materials all the way to the final consumer. So the central idea is important. Companies don't create value in isolation. Suppliers do matter. Production matters. Distribution matters. And customer relationships also matter. So ultimately, the final customer determines whether the product or service provides enough value to justify its cost. The chapter contrasts a value-added perspective with a value chain perspective. A value-added perspective tends to focus more narrowly on what happens inside the organization. A value chain perspective looks more broadly at relationships with suppliers and customers and asks how the entire chain can create more value while reducing cost. From a manager's lens, what's the cheapest supplier? Do you want cheapest supplier or the best value chain? Suppose supplier A charges $10 per component and supplier B charges $10.50 per component. Should you automatically choose supplier A? Not necessarily. What if supplier B delivers more reliably? What if its components have fewer defects? What if working with supplier B allows you to carry substantially less inventory, which can be costly to maintain? What if its information systems integrate with yours and reduce administrative costs? The lowest purchase price may not produce the lowest total cost. That's value chain thinking. And it's exactly why managers need accounting information that extends beyond numbers appearing on an invoice. When we talk about like the changing business environment, it is changing the role of managerial accounting. Competition is increasing globally. Technology has dramatically increased the amount of information available to organizations. Managers now have access to enormous quantities of data, and the chapter talks about big data, robotic process automation, artificial intelligence, and other cognitive technologies. The goal isn't simply to collect more data. The goal is to turn data into decision relevant information. The PowerPoint identifies uses such as finding trends, data mining, uh, operational analysis, process improvements, and strategic decision making. And that's an important distinction. A manager doesn't necessarily need more information. A manager needs the right information for the decision being made. When we talk about enterprise risk management, ERM, um, the chapter talks about ERM as identifying potential events that may affect the organization and managing risk within the organization's risk appetite. Uh, that means accounting information isn't only about how much can we earn, it also helps managers ask what could go wrong? How likely is it? What might it cost us? And what can we do about it? Good managerial decision making considers both risk and return. The final concept I want to emphasize is ethics. So, managerial accounting creates some particularly interesting ethical issues because internal accounting information is frequently used to evaluate managers and allocate resources. A PowerPoint talks about examples such as should a manager intentionally create an easy budget so they can outperform it, or should costs be assigned in a way that makes a favored project more profitable. The cost make the chapter makes another important point. Ethical problems often don't begin with one enormous and unethical decision. They can evolve through a series of small compromises that gradually become normalized. The IMA's ethical standards emphasize competence, confidentiality, integrity, and credibility. Those principles matter because managers rely on accessing information to make decisions. If the information is intentionally distorted, the resulting decisions may also be distorted. From a manager's lens, would you still make some of the same choices if everyone knew? Imagine you're reasonable or responsible for a division's annual budget. Your bonus depends partly on beating that budget. You know you could intentionally overstate expected costs, making the budget easier to beat. You could probably justify it. Everyone does it. It's only an estimate. My team deserves a bonus. That's exactly how ethical problems can begin. But a useful managerial question would be, would I be comfortable explaining this decision openly to my employees, senior management, shareholders, or customers? Accounting systems influence behavior. Managers, therefore, need to not only think about whether a decision is technically permissible, but whether it's ethically inconsistent with the organization's objectives. So, what I want you to take away from this chapter, I want you to concentrate on a couple ideas. The first thing is understand that the fundamental difference between financial and managerial accounting. Um, Financial accounting primarily serves external users, and managerial accounting provides decision relevant information to internal users. Secondly, understand how managerial accounting supports an organization's missions, goals, and strategy. The objective isn't simply to reduce costs, it is to use resources in order in ways that help execute the organization's strategy. And the third thing is you need to understand the role of managerial accounting in the planning, organizing, and control cycle. Managers plan, implement, measure results, compare those results with expectations, and they adjust. Fourth, you need to understand the value chain perspective, how managers should understand how activities across suppliers, internal operations, and customers affect total value and total cost. You also need to recognize technology, data, AI, automation, risk management are changing the information managers use to make decisions. And you need to understand the importance of ethics. Managerial accounting influences decisions, resource allocation, performance evaluation, and compensation. That creates responsibility. The most important transition I want you to make in this chapter is from asking, how do we report what happened, to asking, what information do I need to make the best decisions about what happens next? And that is the essence of managerial accounting. And it's a perspective we're going to carry into our remaining chapters. So in chapter 15, we'll begin by examining one of the most fundamental pieces of information managers need, and that's cost. But as you'll see, simply asking what did it cost isn't always enough. Managers need to understand what kind of cost it is, what causes it, and how it behaves, and whether it is relevant to the decision they're trying to make. That's where we're headed next.